the low price of oil was going to put more money in the pockets of consumers, and that was going to cause a pickup in business and so on. And it was a dividend. I mean, the American public got a big gasoline dividend in effect. That's an interesting point, which we can get to if you'd like, as to why lower oil prices, which should be good for oil importing countries, really may not be in the short run. And we saw what happened on that.
Why is that?
Well, it's a very interesting thing. I mean, we all learned in freshman economics that if oil went down in price, it was bad for the exporters and good for the importers. And certainly when we had the oil shock back 40 years ago, it was a tax on America, and the Saudis were leveling the tax and so on. There's no question that it is good for the country to have lower oil prices. But what happens is that the benefit to the consumer feeds in. Next time you go to the filling station, gas station, you save 15 or 20 bucks. It feeds in very slowly, but the capital values disappear immediately. So if you're sitting with an oil industry in this country that's producing 10 million barrels a day or something of the sort, that's at $100, 10 million barrels a day is $1 billion of revenue, 365 billion a year. Capital values may be 2 trillion based on that. Now all of a sudden you take it down to where you're not making any money, and the 2 trillion of capital values disappears very quickly. The bank loans against it get sour very quickly. They quit buying from the service companies very quickly. So the negative effects to this huge capital value happen very quickly, whereas it feeds into the consumer very slowly. So even though it's good for the country net when you're an importing economy, it can be very bad in the immediate effects it has.
But we're not looking at an immediate effect anymore. We're anniversarying these low oil prices.
Right.
So you are talking about an extended period of time. Does it actually change in the point in the economy where we see it coming in?
But of course, the loans against the oil companies, they don't go bad the first day and all of that. Sure. So there's you get a lot of fallout in terms of capital values that hits fairly fast, and the banks feel it, and the oil equipment suppliers feel it. So all of those things contract very quickly. People lose their jobs in the producing areas. So some very tough things happen to the economy fairly quickly, and the benefits just keep kind of flowing through slowly.
That explains the correlation that we've seen in weak oil prices and weak stock prices. Is there a point where you think that correlation loosens up, though, and we start to see the benefits instead? Overall,
it's good for an oil importing country, which we are, to have lower oil prices. If oil were free, it would be good for us. It wouldn't be very good, you'd have this big adjustment of the oil industry, which would happen immediately, and so it would clobber us in certain areas initially. And housing would be bad in Houston, and all kinds of things. And even now, we have a furniture operation in Houston, and we have them throughout the country. Our Houston furniture operation,
the Nebraska Furniture Mart.
Well, this happens to be a company called Star. We're in Dallas.
Okay.
Dallas hasn't been hit the same way, but Houston, we've done the worst in furniture among our various operations. But that's to be expected.